Welcome to another episode of Simply Invest series. Today we are going to discuss 3 ways to know whether an investment is overvalued. This is something many of you have been asking, and we are going to share some simple methods to do so. When we talk about valuation, we are really referring to how much a company's price is traded at versus how much it should actually worth. The first way to determine whether an investment is overvalued is through precedent transactions. This is a form of relative valuation where you compare the company in question to other businesses that have recently been sold or acquired in the same industry. These transaction values typically include head-on premium included in the price for which they were acquired. For all our case study purposes for this video, we will be looking at Singapore telecom company Singtel and attempt to value the stock price. Now, please be mindful these are just illustrations and in no way a recommendation for you to buy or sell stocks. Take a look at this acquisition of M1, another Singapore telecom company who is Singtel's direct competitor. It is acquired for $1.9 billion. Now, to compare this, we will take a look at Singtel's net income first. It stands at $1.07 billion. What about M1's net income at the point of acquisition? It stands at around $130.7 million. Using their net income as a relative point for comparison, we can derive that Singtel now is roughly 8.22 times bigger than M1 at its point of acquisition. Now, multiply 8.22 by M1's acquired value of $1.91 billion, we can derive that Singtel is worth roughly $15.7 billion. We then look up Singtel's number of shares outstanding, and the value stands at 16.32 billion number of shares outstanding. Now divide how much Singtel is worth, 15.7 billion, by the number of shares outstanding at 16.32 billion, we derived an estimated intrinsic price of 96 cents. Alright, the second way to value a stock is what we call comparable company analysis. This is also a form of relative valuation method in which you compare the current value of a business to other similar businesses by looking at trading multiples like the price to equity ratio, what we termed as the PE ratio. A quick look up at StarHub Financials, which is the only other Singapore telecom company which is still publicly traded. And we can see that it has a PE ratio of 12.677. With a lack of enough data points, let's simply just get the average of P ratio across telecommunication sector, and this stands from 10.61 to 13.62. For simplicity, let's assume that PE used for comparison purpose here is 13. Notably, a figure that is also still higher than StarHub's 12.677. Now, to recap, Singtel's net income is around $1.07 billion. Multiply that by our industry P ratio of 13 and we can derive a valuation of roughly $14 billion. Again, let's divide this number by the number of shares outstanding of 16.32 billion and we derive an estimated intrinsic price of around 86 cents. Alright, the third method will require you to do some mathematics, so do get ready. We would like to introduce you to the Gordon dividend growth model, which is also known as a version of the dividend discount model, and is a method that equates the stock's intrinsic price value to the present value of a stock's future dividends. Alright, this might sound a bit complicated, but trust me, it is not, and we're going to illustrate this with a very simple example. The formula to do so is to use next year's dividend divide by the cost of equity minus dividends growth rate. Now, the cost of equity is the rate of return required to persuade an investor to make a given equity investment. This can be estimated using a CAPM model with the following formula. Risk-free rate plus beta times market return minus risk-free rate. For risk-free rate, we will use Singapore's 10-year bond rate, which is currently around 0.83% as a representation. Beta represents how correlated Singtel stock is to the market returns, and for this purpose we use an estimated beta value of 0.75. based on last 5-year monthly returns. For our market return value, we will attempt to use Singapore Straits Time Index annualized market return of 9.2% over the last 10-year period. Based on our formula, risk-free rate of 0.83% plus beta of 0.75 times market return of 9.2% minus risk-free rate of 0.83% gives you a cost of return of 7.36%. So let's keep this in mind first as we move on to the next part of the equation. Let's assume this article is correct. Alright, and the sales of proprietary assets of Singtel's subsidiary Optus is materialized, and therefore dividends will raise back to 2019 level, where stakeholders will now rejoice after receiving lousy dividends for the year of 2020. Alright, with a dividends per share back at 0.175 per share next year for 2021, we can multiply that by the number of shares outstanding, which is here 16.32 billion, and derive dividends amount for 2021 at 2.86 billion. Okay, moving on, based on Singtel's dividends track record, we can safely assume that as dividends are back to normalized level, there will be no dividends growth going forward, just like there is no dividend growth in the past. Hence, our G value is 0%. Now, let's put everything together. Dividends for 2021 is 2.86 billion, cost of equity is 7.36%, and dividend growth rate is 0%. Applying this to the formula, 2.86 billion divided by 7.36% minus 0%, and we derive an intrinsic valuation of 38.9 billion. Again, let's divide this number by shares outstanding, 16.32 billion, and we derive an intrinsic share price of $2.38. Given that the last referred to price of Singtel when I put the price was $2.47, it looks like their best case scenario price of $2.38 is still under current market value. So, does that mean they are overvalued? What are your thoughts? Please share with us under the comment section. We hope that you have enjoyed the methods that we have shared, and if you have not checked out our previous video on the 2 minutes drill that should be conducted on your investments frequently, please click on it now. If you do enjoy our content, and please click the like and subscribe button now. We really do need subscribers like yourself to keep the channel going. Thank you.